Welcome to the Kaiser Report. I'm Max Kaiser. Welcome once again to 2016. I hope you enjoyed our Winter Why Not series. Now it's time to return to rounding up the headlines that matter. Markets, finance, scandal, and Stacey.
Max, it's been a very busy beginning of the new year.
Talk to me.
Okay, calm down for one moment so I could tell you that Puerto Rico defaulted, Ukraine defaulted on their debts. A redneck caliphate has been...
Defaulting is the new black.
A redneck caliphate has been declared in Oregon.
A redneck caliphate in Oregon? How do I sign up?
Yeah, Al-Qaeda, they call them.
Al-Qaeda.
Fantastic. So a mayor of a town in Mexico was assassinated within hours of taking office, which is bad news. Close ally of America and, of course, falling apart in terms of law and order there. Banker bashing has drawn to a close as the FCA, the Financial Conduct Authority, decides that there is no conduct issue within the banking sector. Banker bashing draws to an end as financial watchdog scraps review.
No. Banker bashing has just begun. This is an atrocity. Why would they call off investigations? In other words, David Cameron, if he's soft on terror and soft on the causes of terror, then expect more terror. They can't just allow terrorism to be financed. Why not cut off the financing of terrorism? It's cognitive dissonance. They don't see, they wonder, how did ISIS become a multi-billion-dollar global enterprise? Is it because these banks gave them the money, you dundercoff?
Well, the remarkable thing about it, as the articles point out, it was triggered by the biggest conspiracy in global financial history, which was the rigging of the LIBOR rate. And once they started to investigate the rigging of the LIBOR rate...
Yeah, here's number 10 Downing Street. Here's David Cameron. It's like, Samantha, look what I found over there at the FCA. But this has nothing to do with the various collapse of the world's financial systems. Well, I wonder how that happened. I wonder, where did this come from? Oh, is this HSBC or Barclays or Lloyds or RBS? It certainly is. Is this disrupting the global financial system and the integrity of our country? Yes, it is. Do I make any connection? No, I don't see any connection. It's Jeremy Corbyn. Jeremy Corbyn, the labor leader. It's all his fault. It's not the big fat bankster rats.
Well, yes, it was triggered by the biggest conspiracy in global financial history, and investigating that, they did uncover the ISDAFIX rigging. Then they uncovered the Forex market rigging. Despite all of those, they've decided that there is no cultural sort of problem there. It's just an individual player's problem.
The money that they made rigging the markets went into terrorism. Yeah. Full stop. And Cameron knows it. He supports it. And he is
Let's move on to the next headline then. And big story of the year, of course, while we were away in Sicily, there were massive floods. Yet again, within a few months of the previous once-in-a-thousand-year flood, there was another once-in-a-thousand-year flood. Revealed how Tory cuts are wrecking UK flood defences. They were voted in as a majority government only a few months ago, and part of their how they got elected was that they said we're going to introduce even more austerity, and the population, the voter, did prefer that, including up in that area. One of the towns that has been washed away did want more austerity. A lot of it came in their flood defenses. Those are now washed away. I saw an article this weekend that people are trying to sell their houses now because they're sick and tired of always having to bail out all these floods, and dry out their homes, and everything gets ruined, and thousands of pounds of cost. So they're trying to sell their homes and hope somebody else, some greater fool, will go up there in austerity England and have to deal with the bailing out their, their basements and whatever.
Oh, David Cameron's making a speech about this. He's making David Cameron's speech. David Cameron is a flood instinct. You can't insure these homes anymore because you can't get flood insurance. They're worthless. The economy is going to be impacted by a factor many times greater than the flood barriers that would have been constructed that they cut to bail out the banksters. So these two are connected. It's like, look, we don't see the terrorism on the City of London, even though it funds our retirement account, wink, wink. And there's no connection to the flooding all over northern England. We can't frack there anymore either. There's no connection because they're blinded by their own egos and their own greed.
Now,
they're blinded.
A lot of normal people out there, ordinary people looking at the markets, looking at things, looking at their leaders, taking care of them, they think everything is normal. They think it's all okay. Except for if you look at the Financial Times, if you look at the financial reports, if you look at what bankers and investors actually think and are doing, the calm expressed by many people should cause alarm. Here's the Financial Times, and this was on New Year's Eve. They tweeted the S&P finished its worst annual performance since the financial crisis in 2008. So you and I have been talking about that. The Baltic Dry Index, the Commodities Index, all of these are the worst since 2008. It's quacking like a collapse. It's quacking like a financial crisis, just like in 2007, 2008, 2009. So many indicators are saying that this is the case. Chris Whalen, regarding this FT headline, said markets are starting to reflect economic reality. No income growth. That's in the personal income growth. We know that incomes are down. Some of them in in the UK are starting to rise a little bit, but they're still down 5% since 2008. And all of the share buybacks has been creating an illusion of income growth by many companies.
No, it's like, the average British person, they're at home in their little hovel somewhere drinking tea, watching the BBC. I saw a report saying that the BBC is the most trusted media outlet in the United Kingdom by a huge factor. Here are these tea drinking blue hairs in the Shires drinking their tea. Oh, there's that lovely the BBC. Everything is fine. David Cameron's a really responsible prime minister. Everything's fine. No, I won't be concerned about it. And that's the typical British person. Of course, they're completely unaware of the threats facing them economically, existentially, because they watch the freaking BBC.
And here's more indicating a collapse in global trade, in global business, and global income, and that is Chicago PMI comes in at 42.9, has never been this low outside of recession. This is going back to the early 1970s. All the red lines are recessions. As you see, we're down here right now, and we've only ever been there during recession, but we'll never officially, I think they're trying to never officially go into recession again. They'll always try to massage the numbers and manipulate the numbers, but the facts out on the ground say something different.
Well, let me give you a history of the last 300 years, 400 years of economics. You had, for many hundreds of years, during the medieval period, of course, you had people at war with each other to gain treasure and landmass, and that was a zero-sum game. And you had various empires trying to steal from other empires to invade other empires because land and treasure, that was perceived as the strength of an empire. Flash forward to the modern era of financialization, where you don't need landmass or gold or silver to constitute great wealth. You need access to a central bank who's going to print trillions of dollars on your behalf, and you can go out and buy precious art. You can go out and buy precious minerals. You can go out and buy for real estate in San Francisco with the money that's being printed. So we went from a mercantile medieval economic model to a post-medieval central bank. Remember, the central bank was created in the Bank of England was the first in 1694. It bridges the medieval period to the modern post-medieval period in financialization of assets and financialization of monetary policy and of geopolitics. And that created a period of credit growth that we are now at the end of this period of credit growth, because you cannot create more than 60 or 70 trillion worth of credit like we have in the global economy today. We've reached the end of that credit growth cycle. So now we're going back to a medieval period where people are fighting each other. They're fighting wars over what they perceive to be the prima franca of this new post-monetary period of wealth, which is back to medieval times of land, assets, armies. Okay, so we're going back to wealth as defined by stuff and land And so as a result, we're going to be into a war. We're warring. People are fighting. The wars are breaking out now because the central banks' promise of free money for plutocrats forever without any consequences has proven to be a bust.
We're going to talk about that in the second half in this imminent looking like collapse of Saudi Arabia, but I want to talk further about the Chicago PMI coming in at 42.9. Economists had predicted it would be a 50. Exactly 50. Now, anything below 50 means there's a recession, it's declining.
Sorry, this is the Purchasing Manager Index?
Purchasing Managers Index, yes. So here, this is just for Chicago, and the thing that is unique about the Chicago PMI is that it also counts services. So that's declining. It's down from 48.7 in November, down to 42.9. So the trend is not the actual activity, business activity happening. So business is not happening.
Right, this is
certainly
an indicator,
not in Chicago.
On the corporate level of purchasing managers, middle managers doing middle management stuff by purchasing stuff.
Yeah.
And so this is collapsing because the basic day-to-day, daily grist of business is collapsing.
They're looking at their future orders, their backlogs, they're looking at what's going on, and it looks really bad.
They're not buying any more candy for the candy vending machine.
No.
Because the employers are gone. They're gone. They're unemployed.
And quickly, what the Fed or Fox, CNBC won't tell you about the West Coast home prices. And this is from David Stockman, former
I love
head
David
of the CBO.
Stockman. He's a genius.
Let's quickly go over this because he said, none of the business news in America will tell you this, but we'll show you. Here is the Phoenix house prices up. Here's median household income down. Here's San Francisco prices since 2011 up. Incomes down.
Oh my God.
Here's Los Angeles since 2011 as well. Prices up. Incomes down.
Those are house prices.
Denver, the blue line, houses prices up. The yellow line, incomes down. The only place, of course, where incomes are rising along with house prices is Washington, D.C. And that's never a good sign for your economy.
Well, yeah, that's the new kleptocratic class in Washington, D.C. Right there with the central bank is also in Washington, D.C. If you're next to the central bank, then you're going to be benefiting from the central bank. But that era is now over as we enter World War III, period, because monetization is over. Can you stay for the second half? Because we need to discuss this more in depth.
We're going to talk about debt
January.
creation.
It's fantastic.
Yeah.
I'm having a revelation, and it's all based on this liquidity that I feel. I'm very liquid right now. For the second half. I hope that more. Hey, we're back. Kaiser Report. Max Kaiser and Stacey Herbert. Liquidity everywhere except where you need it most.
Well, regarding what we were talking about in the second half, we were talking about the debt crisis continuing, incomes declining, real incomes declining, and all the asset prices increasing because of debt and credit.
Real incomes are declining.
Yes, we're going to talk about that in a bit, but first I want to start on a positive note about what happened in 2015. Bitcoin was the world's best performing currency in 2015, up by 40%.
Wait, we're just going to skate over that? Why can't we talk about the Bitcoin?
We've talked about that a lot, and we
not enough.
were right. Okay,
it's the best performing currency of 2015.
Yes.
Bitcoin. Okay? Nobody else comes close. It's going to be the best performing currency of 2016 as well. It's going to hit new highs in 2016, along with Startcoin.
Other than 2014, it was the best performing currency for the last 5 years as well. Now, also, how do you make financial bets? How do you invest in an environment in which the controller of global credit, the U.S. Fed,
I borrow money.
Well, exactly. That's what people should do. And should have been doing for the last 10, 15, 20 years, because the Fed will always have your back. If you're a debtor, the Fed has your back. And they will rig markets, they will manipulate capitalism, and they will manipulate free markets in order to guarantee your income. But how do you, how do you invest in this sort of environment? Now, in 2007, 2008, one of the biggest bets people earned famously like billions of dollars. John Paulson, hedge fund manager, earned $3 billion betting against the subprime mortgage market. Well, what in the next collapse?
The Big Short.
What is the Big Short? What is the Big Short for this year, this upcoming collapse? which we think there's an upcoming.
What is
less.
it? I'm on Tinderhooks there. I can't take the anticipation. I want to know.
So here's from Zero Hedge, from $500,000 to $170 million in a few months. The next subprime trade emerges. So first we'll set the environment of this investment environment. And Zero Hedge actually looks to a Bank of America report in which they say central banks' risk manipulation well explains local tails. So a good way to explain why we have seen local tail risks rise so frequently since central banks began to heavily manipulate asset prices is with the following analogy. Essentially, central banks, by unfairly inflating asset prices, have compressed risk like a spring to unfairly tight levels. Unfortunately, the market is aware the price of risk is not correct, but they can't fight it because, of course, you don't fight the Fed. And everyone is forced to crowd into the same trade. By manipulating markets, they've also reduced investors' inherent conviction by rendering fundamentals less relevant. And Bank of America goes on to say this has made the markets very unstable because you as an investor, a long-term investor, can see that prices are wrong, but to invest accordingly, you're betting against the Fed and that the Fed might come in and put negative rates, negative 5%, negative 10%, and just destroy you.
Well, like I said in the first half of the show, we've had for a long, long time now, you could say going back to the 1694 creation of the Bank of England, a period where there's been a growing awareness and technological ability to separate risk from reward. Because up until recently, risk and reward were bound together. But starting in the 70s and 80s, and the adoption of the options pricing volatility formula and other modern incantations from the quants and mathematicians to create what we know as derivatives, you have the ability of separating risk from reward. This is how the great plutocratic wealth has been generated over the past 20 years, not because people have made smart bets on companies or commodities or currencies that are about to go through price appreciation cycles. They've made their great wealth by eliminating their risk, by packaging that risk as a derivative and putting it into the public domain. We saw an excellent example of that in 2008, post-2008. All markets went down, but the plutocrats were able to jettison all their risk, put it into the public domain, and ride the cycle up. And the greatest wealth aggregation in history happened in the last 7 to 8 years. People who had $100 million now have $500 million. People who had $1 billion now have $6 billion because they were able to take the risk of owning that capital and processing that capital and turn it into 0% interest rates for savers, no capital expense, no hiring, all using borrowed money to buy back your stock to inflate your earnings artificially. No attention to the externalities of ecological holocaust from the likes of Exxon or Monsanto. That's all been put into the public domain. And the elimination of all organized labor. So this is the result, is that you have aggregation of extreme wealth at the extreme top. Then the risk has been socialized, and the capital gains have been privatized.
So here, the big bet, the new subprime bet, is not against the market, not against any prices or anything like that the Fed could intervene in. The big bet is against exchange-traded funds. And ETFs are basically based on the Black-Scholes options formula, based on all these derivatives, based on, and mom and pop investors have been piling into them because they seemingly are low cost. So the costs are much lower. It's the ability to seemingly have hedge fund-like returns without the hedge fund performance fees, and they've been piling into that. Well, the best performing fund in 2015 was by a Michigan native called David Miller and his Catalyst Macro Strategist Fund, and he has been betting against ETFs. A trade which involved betting on the collapse not of the central bank supported market, but the death of the instrument which allows this unprecedented global central bank put to prop up markets, and which, like the infamous coiled spring in the Bank of America revelation, is just waiting for catalysts to snap. In other words, betting against ETFs. So he's betting against the double leverage or the triple leveraged ones, especially because of the flaw in how they are. Basically, a lot of people think there's a lot of liquidity there that actually isn't there, especially because they're all mom and pop investors in these, and they all pile in when prices at the same time, and they all flee at the same time.
Well, it's like a variation on fractional reserve banking. When you say that a bank, for every dollar in deposits, they've loaned out $1,000 or $2,000. Now, if those loans were all due at the same time, obviously that $100 that they have in reserves would be obliterated instantaneously. And that, again, going back to the crisis of 2008, we saw an implosion of the fractional reserve model and a liquidity crisis and a seizing of credit globally. Now, an exchange-traded fund, similarly, would be a derivative. It would be I don't know why I'm holding this cup, actually. I was going to make a point with this cup, but I'm going to put the cup down because it has no relevance to what I'm about to say. So an exchange-traded fund would have, let's say, shares of IBM, and it might be represented in 100 different exchange-traded funds. You know, 100 different, an exchange-traded fund is merely a basket of stocks that are mimicking or riding on the price action of the underlying stock. So let's say 100 different exchange-traded funds, and there are thousands of these now, all have IBM in their basket. Well, if IBM were to suffer catastrophic earnings collapse, as it's doing now anyway, and all the exchange-traded funds needed to be cashed in simultaneously, you would have, therefore, a cascading effect like you had in 2008. So here you have a guy who has pointed this out, and is riding this big short.
Yeah, because the ETFs are mimicking prices. They're promising, for example, that they're going to capture the price of bonds or emerging markets. They don't actually have to own any of those shares or anything. All they need to do is come up with some exotic formula to mimic that price movement.
Right, so that's a good point.
He's also doing the same thing, and it's actually very complicated. Shorting the subprime mortgage market was pretty easy because ETFs were actually created to short the market to mimic that. So this, however, is a little bit more complicated, and his fund has returned 50%. But it's a complicated,
right. So
crazy
that's a good
thing
to point out is that if you have an ETF and it says IBM is in the ETF, it's just a derivative. It's a notation
based on some options that might
it's
not.
Based on the. It's not. They're not shares of IBM.
Yeah.
So therefore, if everyone cashes out at the same time, it says in the prospectus of this ETF that they have no responsibility to make good on the price.
So let's quickly tie all of this together into the Saudi story, the Saudi collapse, and the U.S. in terms
the Saudis are collapsing?
Justifying. Well, I think so, but justifying the default by Ukraine example. And we covered that at the end of the year. That Michael Hudson thinks that the notion that the IMF now has allowed sovereign defaults, and they will continue to lend to people who have defaulted, like Ukraine. So this is the first time in 70 years that has changed, and this is about the new world order of a new creditor coming on the market. And this is competition, and here is Bill Bonner saying the same thing. At times, it pays to raise your head and look around. So he's saying that basically he's looking at Peter Lynch. Peter Lynch, famous investor, says he never looks around. He never looks at the big picture. He looks at individual stocks and the companies and invests in what you know. And here Bill Bonner is saying sometimes it pays to look at the big picture and what's going on. So he looks at the oil market and what's happening there. And this is a battle between an oil pumper and a credit pumper. And they're both trying to maintain.
Well, I just said that, too.
Yeah, exactly. But they're all both trying to maintain their market share. Saudi Arabia is one of the lowest cost producers in the world. They could pump at $1 a barrel, and they could pump in order to drive out their competitors. But what he says, the Saudi product is oil. Its strategic goal is to protect its market share. It does so by flooding the markets occasionally and driving out their competitors. But wait, now coming into focus is an even bigger picture. For half a century, cheap oil abundantly and conveniently under the dry ground has made the Saudi elite rich. They sold it all over the world, using the proceeds to build their wealth overseas and reinforce their power at home. They paid off political leaders, raised armies to protect themselves from foreigners, and hired police to torture their opponents at home. Cheap credit, however, is America, and they are flooding the market with cheap credit in order to drive out their competitors, including China and their AIIB bank, their Asian Investment and Infrastructure Bank. And cheap credit gushing up like an overflowing septic system has done much the same thing for America's money elite too. So they were able to pump cheap credit into fracking, which otherwise makes no financial sense, but it's a way to compete with the energy pumper.
Right. Bill Bonner, great writer. And this is a great way to sum up this entire show.
Yes,
because you have the money pumpers.
Yes, the credit pumpers, not the money pumpers.
The credit pumpers, which are derivatives enhanced to allow you to pump more credit than would be normally feasible if there were true underlying economic principles in play.
And we saw that actually in the chart provided by David Stockman of the only place in America with rising house prices and rising income, Washington, D.C.
Where they pump the credit.
The control of the value of the credit is backed by the military.
Right, but now we're entering a period where that credit pumping period, which really goes back to the Bank of England and 300 years worth of credit pumping, is coming to a close. And we're going back to, and I think that's the true message of so-called terrorism in the past 10 or 15 years, is that we're going back to a medieval period of economics where it's going to be more based on barter, more based on actual stuff, and less on credit pumping, which was always an artificial concatenation, pulled out of a central bank swing to try to justify their own inflated salary. But we must go.
Well, that ties in all of the stories. The Bitcoin is no counterparty risk, just like gold or silver. You have an ounce of silver, you have an ounce of gold in your hand. You cannot lose money on that. You might lose purchasing power, but you do not lose money. You have money in your hand, not credit. You have money.
Well, that's going to do it for this episode of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. Get in touch on Twitter with Kaiser Report. Until next time, bye, y'all.